G'day. It's Stefan Angelini on the 1st of May, 2023 for another little economic wrap. Thanks for joining me today. What are we going to go through? We're going to go through a few nice little things. First off, first home buyers and the proposed expansion of the first home buyers grant, where you can add in perhaps family members to support you in buying your first home. Going to talk about home price rises and how the Australian property market has just had its second month in a row where prices have increased. We'll talk about commercial real estate and the worries some of the major economists around the world have for the sector. And we'll also talk about buckling up, how ANZ's chief economist has said that a lot of small business that have a lot of debt will face issues in the coming few months. So be aware. Now, before we get into the full wrap, this is just a general disclaimer. So please ensure that you know that this is all just general information. Please don't consider it as personal advice. And if you want any personal advice, please go and consult your licensed financial advisor. Hey, that's us over at Angel Advisory. If you want to listen to the full episode, get on over to the Real Wealth Podcast with Stefan Angelini and you can listen in there. Let's talk about what is going on in the world. First home buyers guarantee, or the family home guarantee, may be expanded in the most recent new proposal. So what is the government saying? Basically, they're trying to expand the definition of a couple. Now, at the moment, thousands of Australians could benefit as a result of this. Normally, it's for couples, de facto partners, or singles. That's the definition. But now the government has said, well, let's try and expand that definition of couple into a pair of friends, or perhaps even family members. As we dig down a bit deeper into it, this will be expanded to first home buyers who also haven't owned a property in the last 10 years. So what that means is that it might open up to people that have not been able to own their home due to financial crisis or relationship breakdowns, and it's sort of just left them out. Now, this could be really great for the property market and increased demand. So we'll see what happens in that space and whether or not this is another contributing factor to driving up property prices. Importantly, let's just wait for this to actually be legislated. It will impact on all guarantees and therefore hopefully really good thing for Australians trying to get either back into the property market after 10 years or for people just trying to get into their first home because we know it's super expensive. House prices have risen for the second month in a row and rent prices have increased by even more. So what's happened out there? House prices in all capital cities have increased by an average of 0.5% in April. So that's 2 months in a row. And the one who led the chase was Sydney. After, of course, the biggest drops, and I'll tell you what's happened there. But also rents have risen by 1.1%, with the average weekly rental rate outpacing for units as outpacing standalone houses. So units are getting more expensive than houses, I guess, because it's more affordable, because rental prices are going up so much. Let's look at the changing dwelling prices for each major city. So as I said, Sydney has had a comeback now. So last month, they increased by 1.3%, whereas Melbourne increased by 0.1%. So that means for the quarter, Sydney have increased by 3%, Melbourne has increased by 0.3%. On an annual basis, Sydney has still dropped by 10.7% and Melbourne has still dropped by 8.9%. So it has come off quite a bit still, but this does give us confidence in going forward, but we'll see what happens to markets. Let's look at what some of the most influential economists have been saying around the world. So they are predicting a painful credit crunch meltdown in September or when markets get into a recession. And one of them even saying that a commercial real estate will have a big hit to its performance. Now, the first guy we listen to is David Rosenberg. He's a former chief national economist at Merrill Lynch, so a very, very big company. He tips the US will enter a recession in September 2023 and that stocks and other markets will go down by about 20% in this damaging credit crunch. Now, a lot of other economists have actually feigned away and said, we're pretty confident in the way things look moving forward. But another large economist being Mohammed Al-Arayan, he's a chief economist at Allianz. He has said that large institutions will be okay in the macro environment, but he's worried that smaller companies will be punished. But also any companies with operating approaches that are not easily adaptable to higher interest rates. This includes largely the commercial real estate sector. So it'll be a moment of truth when a lot of these commercial real estate debt holdings come up for, I guess, renewal in the next 18 months and what happens then with larger interest rates. In the US, there's about $1 trillion worth of loans out for commercial real estate that'll have to be refinanced in the next 18 months. That's quite a lot. So see what happens in that space. Finally, the ANZ chief economist has said to small Australian businesses, buckle up. Despite the nation's inflation rate dipping by 0.8%, Shane Elliott has said that the financial strain on businesses will continue for some time, especially with higher interest rates. And it's about starting to get rocky, with the casualties of those businesses facing with much too higher debt and no pricing power will be the ones that are firstly impacted. So as small business owners out there, get your debt under control and make sure you've got a plan to get rid of it. And if not, please make sure you are just watching your cash flow quite intrinsically, and if possible, pass on those price pressures to customers, because no one wants you going out of business. Anyway, that's my little wrap for today. Thank you a lot for listening. Hopefully you go off and have a great week. Cheers.